Yeah, good morning, everybody. So what I'll do is I'll spend maybe 15 to 20 minutes to give a flavor of what we see as far as the FMCG sector is concerned and some flavor of how we plan to participate in the growth. So if you really look at it, again, I think we are seeing some recovery, primarily in US in developed markets. Emerging markets, including China, facing headwinds. And I think as far as India is concerned, and I think that's one thing which I think we must say that we are in a very sweet spot in terms of at least the medium term is concerned. That once one of the more fragile of the BRICS, say 2 years ago, I think we are the last of the BRICS standing in terms of the resilient. And if you really look at it, it is a resilient economy, and the government is intently focused on investment and growth. And yes, if you look at 18 months ago, the kind of expectations that was versus that, yeah, I think the expectations were too much. And versus that, there is an expectation reality gap, and a lot more can be achieved. And I think some of the series of reforms which are more executive and not legislative, which has got started, is something which hopefully will drive some of the consumption in this country. And I think before consumption, I think investment has to start. However, the FMCG medium to long-term story is very much intact. It's a $40 billion with 36% rural share. We have most of the categories still at the bottom of the S-curve. There's huge opportunity for penetration, especially in packaged foods, premium personal care, the 1.2 billion people. And then the fact is that I think it's, and this is, I'm going to cover it later, about distribution, that distribution is a source of competitive advantage and an entry barrier for a lot of people. The fact that we still have 9 million outlets. We have heard a lot about, obviously, modern trade, and e-commerce is here to stay. Maybe e-commerce, the big e-commerce players who have better business models have a better chance of profitability than brick and mortar modern trade, given the costs of employee and real estate costs in India. But I think the three organized retail, e-commerce, and unorganized retail general trade are here to stay and coexist. Now, what are the FMCG opportunities, you really look at it? And I'm talking of medium-term opportunities and not immediate opportunities. I think the biggest one, which our Prime Minister keeps on telling about, and I think the demographic dividend, and the fact that people in terms of the age group, working population, the middle-income households up, and I think the people wanting to are aspirational. And if you really look at the biggest shift that has happened in the last 20 years, that India has moved from what I call the people who were born in the 60s, 70s, to an extent maybe mid-80s, but definitely before mid-80s. And they were born and brought up in what I call a savings and a thrift mindset, that there's a scarcity mindset, and therefore that also translated into their consumption patterns. People who were born after mid-80s and who were, when they did their schooling in their 90s and their college thereafter and started working post-liberalization, I think they are far more confident about the future, and they are much more a consumption generation. And of course, then those who were born in post 99 and 2000 are the digital generation, and there are 3 generations in India. And therefore, I think it's important to understand that they want to look good, they want to stay young, stay healthy, and therefore there's enough opportunities for beauty and wellness products in this country. And the other change that has happened with a common media, common Bollywood, common culture, is that the aspiration of the rural folks are similar. It's no longer about 10 years ago or 5 years ago that I develop a product which is different in rural and which is in terms of a different quality. They want the same top-end product, only difference is the outlay is something which they want to maybe compromise on. So you need to give a lower unit pack of the same aspirational top-end brand to drive growth. I think the Make in India is something which will generate employment and disposable income, and hopefully there would be some investments as we see, given some of the steps that have been taken in the last 2 weeks. Yeah. I think the GDP growth, and again, let's forget about what base is right or wrong, but I think definitely our growth is better than what it was 2 years ago. And if you really look at this growth, if you have sustained higher growth quarter after quarter, it will lead to higher consumption. And typically, if you look at CPG, it grows obviously 2 times GDP. Now, one of the things that happens when you come out of a cycle of high inflation and lower economic growth, there could be a situation where during that time that leads to savings depletion, and therefore consumers first tend to pull back and get back on the saving space. Obviously, when there are new trends, like for example, if you are looking at e-commerce today is a big trend in India, and what happens during these kind of trends is given the fact that people are aspirational and want to get into things like durables, things like buying the upgrading of your mobile phones and smartphones and all that, obviously some share of wallet moves to that, and that is something which is not long term. But if you look at long term, CPG usually grows 2 times GDP growth. And we are very happy that yesterday's recommendation of pay commission, things like OROP and consistent lower inflation, if crude continues to stay at this level, and in terms of we don't see too much significant increase in MSPs fueling some kind of inflation in food inflation, we believe there would be higher disposable income in the next 18 months or so. Now, yes, there are concerns on the rural, and which I'll cover later, but I believe that it should be more than made up in the urban consumption. I will cover quickly some of the game changers. They can be game changers in the industry or disruptors. Now, how you look at it, if you don't seize the opportunity, it will become disruptors. And I have covered 4. One is the entire thing of digital and e-commerce. Second is the changing distribution landscape. Third is GST. Fourth is unconventional competition. It could be a Patanjali, it could be a Hector Beverages, it could be anybody. But I think these are the 4 what I call the game changers or disruptors in the industry. The first one is digital, and I think if you look at digital, our industry is perhaps at the lower end of the curve compared to telecom, retail, financial services. And I think it has also got to do with, if you want to take an industry digital, it has to start off with the digital savviness of the people at the top. And just don't get me wrong, I am not talking of the age of the top management. It has got to do with the mental framework of how digitally savvy you are. If you want digital, this one, and it's not just about e-commerce, the way you interact with consumers, the way you capture insights, the way you look at online reputation management of your brands. Your online reputation can get disturbed and spoiled within 2 hours through today's social media. The way you look at analytics, for example, the kind of spends we do in A&P, in discounts and trade, how can analytics help you in actually effectiveness of spends? And this is one area which, and also I think retail trade, I'll just give you one example. If tomorrow there is today we have this entire phenomena of every company has thousands of feet on street going to the retailer every week, taking orders and delivering it. What about, say, 2 years hence or 3 years hence, there's an app which a retailer actually gives order, because today we are selling through smart where you can actually have things like suggested order quantity based on your patterns of offtake or your patterns of this one. So I think this entire space of digital and e-commerce can be a source of competitive advantage or could be disruption, and that depends on how the senior management who have not grown up in the internet age, because I think that's an interesting concept, that those who have not run their formative years either in college or your first job in the internet age, and unless you force yourself to become digitally savvy, you actually don't drive digital in your organization. Secondly, I think the distribution landscape, I see a lot more consolidation and professionalization of distribution. Just like any other trade, it doesn't mean that earlier the entire distribution business it used to go from generation to generation, but just as you're seeing in farming, just as you are seeing in unorganized retail, it is not necessarily the younger generation wanting to take up what the forefathers used to do. And therefore, I see much more professionalization, far more ITization, and therefore direct distribution for large-scale players will be a source of long-term competitive advantage in terms of how much you will reach. You hear stories about, okay, e-commerce, I can reach, I can get around the distribution. And believe me, India is too big. And therefore, direct distribution and reach and scale is a source of competitive advantage. Third is GST. A pure pristine GST is very, very good for the industry. However, if you have a situation of, impure GST, which is that 1% extra tax, you have different states, different classification, and lastly, a revenue neutral rate of anything higher than 20% could be inflationary, which could neutralize the impact of GST. Having said that, I think GST is very good, and we hope that the GST is implemented fast, but in a more puritanistic format, and the revenue neutral rate shouldn't be inflationary, especially for food companies. Lastly, I talked about this unconventional competition. I think people need to be far more, FMCG players need to be agile and need to take competition seriously. Some of the top-end companies, yes, have what I call intellectual capital. Intellectual capital doesn't necessarily lead to results and doesn't need to, sometimes it can drive complacency and sometimes it can lead to arrogance. So I think what is important for anybody is to take competition seriously, be agile, and it can be anybody. I will then start with the key challenges. The first is this deflation. Now a lot of us are talking about this deflation. Is it a boon or a bane? Now let me tell you what works, and I like a lot of mathematical modeling, and so I asked my finance team to actually model this. A deflation can work to your advantage only if you pass on. So suppose I'm giving you a hypothetical example. If you have 500 basis points gain in input costs and that is here to stay, you need to be confident that you are passing on some part of it into pricing and into innovation, because there's no point doing more advertising on the core, because that will not drive consumption, such that your volume growth goes up and pass on something to your margins. Because otherwise what happens if you proactively pass on in pricing and A&P and don't get proportionate volume growth, you will have a situation of both low top line and low bottom line growth. However, having said that, it's okay to still have low bottom line, top line growth, as long as you have decent bottom line growth and keep on going volumes and market share. And that is how to, I think, tackle this. So just to take our example, I think if we can push our volume growth from 6 to 8 and retain some 25-30% in margins and pass on mostly to pricing and A&P, we will be very happy in terms of getting again double-digit earnings growth, and that's one model we want to deliver. As far as monsoon is concerned, I think monsoon, a combination of that plus a little bit of liquidity in the rural sector is a cause for concern. But as I said, if we can get the stuff right on the urban consumption, that will more or less compensate for the rural. The rural slowdown, it's not so much in FMCG, there is a bit of a rural slowdown. But it will be far more in other things because the liquidity is low, because given the fact that there is, the fact that I think government has done well in terms of controlling MSPs and therefore controlling food inflation, and also with direct benefit transfer, the leakage in the system is low, and therefore the leakage and therefore the rural liquidity is low. So rural will stay a little bit soft maybe in terms of 12 to 18 months. The third issue in FMCG, not many people talk about, I think, this issue of counterfeits and lookalikes. And it's not just counterfeits, a lot of lookalikes. While we welcome the regulatory, the action in terms of making stronger laws, transparent laws, making consistent laws to make things, especially in packaged foods and other things, I think the government should be much more tougher on unorganized sector, because that is not, and hopefully GST, one of the big things about GST will also drive a much more level playing field in that. I'll just end my presentation with 3 slides. I think one of the things I believe, and if any strategy and has to be done in one page. So this is something how I believe in an emerging market, any consumer goods company should have a playbook, and it's not very theoretical, but I'll just talk about it. And this is what our belief is, and that's how we run our business. I think the first thing is the foundation. You need to have a profitable, scalable business model. You need to have a portfolio with a right to win. Just because the market is attractive doesn't mean you have a right to win. You need to have your go-to market very well constructed in an emerging market, because availability and affordability are the biggest drivers of growth in emerging market. And the last is having a cost structure. In terms of capability, you need to have process, talent, and innovation. So the reason I'm saying this, in a lot of our international markets, we have had surprising and unpredictable results. And when you come back and you see if these things are not sorted out, you will never have predictability of results. So our sector is reasonably boring, and I think it's important is to have a repeatable model of consistent, sustainable, profitable growth, which could be boring, but a boring growth can also deliver 15% top line and bottom line without making too much into the pink pages. So the enablers are, I think, risks. I think managing VUCA in terms of uncertainty is here to stay. The question is, there is no point management telling that there was this happened and therefore we couldn't deliver. The proof is, everything remaining equal, did you deliver better than others? And therefore you have managed uncertainty better. And I think as far as any FMCG company is concerned, and especially our company is concerned, I think the 4 differentiators which are unique to us is, I think, innovation, brand, values, and culture. And that drives everything. And you might have a right strategy, executional excellence is important. So when I look at a business, when I look at any of our business units, I just look at this page and try to fix everything. And to me, this is something which will drive, what I call a good performance. And what is a good performance? And the first one is getting 8 to 10% volume growth, double-digit volume growth. I think how much percentage of your portfolio is gaining market share? How much of your business is coming from new business? Is your fixed overheads getting down as a percentage of scale? What is the efficiency factor? And lastly, I think ability of attraction of retention of key talent. And again, if I had to put a scorecard for any CPG company, and it could be for any company, for that matter, for the CPG company and definitely our company, this is how we develop as a composite scorecard. Lastly, I'll talk about our growth model. I think we believe that in any emerging market, we need to prioritize volume growth over short-term profits. And volume growth and market share, as long as there's a threshold level of EBITDA is delivered. How are you reinvesting profit for driving growth? I think the third one, a lot of us, and it creates a lot of excitement on inorganic growth, but I believe that inorganic growth can't be a substitute for organic growth and can't be an escape button for not doing organic growth. And therefore, you first need to have, when I've developed that playbook which I talked about, the strong foundation to develop organic growth. Only then you can actually have the appetite to bite into inorganic growth. And I think the fourth thing is getting your pricing and distribution right. Because in emerging markets, if you don't get your pricing and distribution right, you might have the best advertising, the greatest product, but you will not grow. So which brings me to the last question, the last slide, which is our choice-making framework, which we do. I think the first one, we want to enter categories which we have a right to win. Just because it is attractive doesn't mean you have a right to win. Secondly, I think D&E markets, which we have spoken about, that we want to enter only categories and markets in Asia and Africa where there is younger population with huge opportunity for headroom for growth, per capita of $6,000, $7,000 and below. I think the third one is entering underpenetrated categories. There's no point trying to enter, say, hypothetically, shampoos in India. It's a bloodbath. Fourth, I think we avoid markets which dominance of organized retail. So we will not enter markets where organized retail is 80%, 90%. We don't have a right to win. We have a better right to win where there is GT, because that is where our strength is and our ability to leverage and cross-pollinate processes, GT processes. And lastly, I think increased share of value-added categories. We will not enter any categories which are commoditized. So this gives you us a choice-making framework in how we select markets, how we select categories, and this is going to be the framework which I believe which is going to stay with us for the next 3 to 5 years. So that's all I had to say, and I'm most happy to take questions.
Very good presentation, so thank you so much for this. I'll start with a few of my own questions. You spoke about a couple of things which is very interesting. This time around, when there has been this deflationary environment, most large companies have said that the down trading effect has not been there, but there has been a greater, a higher purchase of LUPs, probably of premium products. And I think you also mentioned in your presentation that that possibly will be the way forward. So, how do you see this as an opportunity with reference to your portfolio, where you can, possibly make what you've already done in order to, capture this opportunity where even the mass consumer doesn't want to down trade, but probably will buy a smaller pack of a premium product. So, how do you see that as an opportunity for the portfolio overall?
Especially when a consumer uptrades into, say, value added. Yeah. I think it's important to ensure that you have price points for which becomes affordable, and it works even in a slightly premium brand. For example, one of the things we had been facing, say a brand like Saffola, where we had been facing some kind of a growth pressures because of the people not willing to uptrade and the incremental outlay. So one of the things we have started doing last few months, I think from September, where we started pushing the entry points of Ola, for example, which the price premium actually is mightly lower and has started actually showing some results. So I think it's important. Having said that, I think you need to understand that you shouldn't get locked into a huge percentage of business coming from only LUP packs. Then what happens, this is all very fine in a lower commodity cycle. In a commodity cycle, you will have margin pressure. So you have to manage that and ensure that, because you can't determine how will the consumer behave. But I think you need to keep that as a threshold, how much percentage of your business is coming from your LUPs and price point packs.
The other interesting thing you spoke about from a new product perspective is that you evaluate categories with a very important point, being right to win. How do you really look at categories? Because if it's a new category, there are chances that you have not been in that category before. There are chances that there are already a few players there. So is this, will the strategy be more towards adjacencies from your current portfolio, or certain things that you've done in your current portfolio which give you the understanding of a new category? So, because a right to win could restrict you from entering into a few probably larger categories. So how do you think about right to win, when you look at new categories?
So I think the biggest thing is any category you have to have first is a differentiation. You can't have a me too. And to be very fair, and I think absolutely fair question, this framework will not deliver the iPad in a FMCG equivalent, because if you go with that framework, you will not get into the biggest innovation. Having said that, I think the way we define right to win is things like, are you catering to the similar consumers? Is the trade similar? Is the cost structure and the back end similar? To give you an example, now, just because we did Saffola oils doesn't mean technically you have a right to win in Saffola masala oats. But actually, if you follow that same policy, that you are catering to the same kind of consumers who are health conscious, who are pro-health, a significant portion of Saffola masala oats also goes through modern trade and top-end food outlets. So there is a similarity in this. So there's a similarity in some way in our ability to handle back-end because of foods or whatever and commodities. So I think it's a question of similar capabilities. To give you an example, today if I might not be able to get into salted snack foods, which is chips, which is impulse completely and sold in Pan Plus outlets, because it's a different consumer set, different distribution set. So the right to win doesn't necessarily come from the product adjacency, but it comes from the entire value chain adjacency.
Perfect. Just one last thing was that, we spoke about rural and urban markets. Possibly over the next 12, 18 months, there will be an external driver in urban markets with the 7-pay commission actually coming through, and the numbers seem slightly better as was announced yesterday as compared to some expectations. There's also an OROP impact, etc. Just wanted your sense on what do you think can drive back rural growth, not to earlier levels, because possibly those were led by a lot of inflation as well. But, how do you see rural growths maybe over 12, 18 or 24 months, and what can drive them back to slightly better levels than as you see currently?
See, if there is good economic growth and there is good and low inflation, it will have a trickle-down effect there. Because as I said, the rural consumers are aspirational. Some of the rural growth of the past, during the past government, has been because of a little bit of steroids, which is not there. Having said that, I think my belief is if there is good sustained economic growth, they will have a trickle-down effect. And I think also the dependence on monsoon and rains is progressively going down, because a significant portion of today rural income is not necessarily grain-based agriculture, but it's also much more cash crops and other things. So I believe that what had happened is the ratio was skewed, 1.5x or 2x. It's going to be equal, and maybe urban will be slightly higher. But I don't think for FMCG rural growth is going to really slump. It is a relative, I think it's a relative scene.
Questions from the audience?
Yeah. So you're right here.
Okay.
Right at the back, sir. One of your biggest international business is Bangladesh, and which is very concentrated to a product category. So if you could just give an overview of what's your strategy over the next 5 years to grow the business and even reduce that concentration.
I think, as I said, we perhaps started that process of diversification a bit late. Having said that, I think there is a huge journey in terms of the entire value-added space. And the way we look at it and the way we have done structurally as far as Bangladesh is concerned is we can actually use it as a much more accelerated arbitrage model from India. The reason is very simple. In a relative sense, we are far more stronger in terms of brand equity, distribution, and overall strength in Bangladesh. So therefore, some of the things we couldn't do in India, actually we can do in Bangladesh. In the earlier structure of our organization, unfortunately, what had happened is that Bangladesh was very concentrated in the international business in terms of, it almost became a cash cow. The third thing which we have doing in Bangladesh is, I think, investing in capability. Because if you want to grow, you need to have organic growth capability, which is sales, marketing, and GTM capability. Invest in processes. All that is going on. Is it going to be overnight growth? No. But I think over the next 6 to 12 months and thereafter, we will see growth coming back into the businesses. And obviously, the rest of the business, which is the non-parachute business, has to grow at around 50-60% to get that 10% growth, which hopefully we see that gradually moving towards that. But having said that, there is no reason why we can't be a full-fledged FMCG and a personal care player in Bangladesh, because given our strengths.
Thank you.
So 2 questions from my side. Over the last few years, we've done very well in the hair oil business, despite, industry having its sets of challenges. So just wanted to get your perspective, specifically you talked about the demographic profile. Given the youth habits towards hair oiling over the next few years, where do we see industry and ourselves? That's the first question.
Fair. I think 10 years ago also there was a report on this, how hair oiling is going to die. I'll tell you what, I think the issue is very simple. Consumers believe that leave-in nourishment is something good for you. But as the younger population, you are absolutely right. What happens is, I think we have to increasingly premiumize the format. People believe that hair oiling is good. I think the issue is how do you deliver contemporary formats and drive efficacy. The other big thing about hair oiling where I see a big business opportunities happening, one is obviously hair fall. It's already a 900 crore market and growing very well. The other thing, as people use more modern hair care styling methods, there is hair damage and people go back into nourishment formats. So I think the challenge is how do you deliver format which is sensorially and in terms of efficacy either does problem solving. To give you one example, if you see anti-dandruff shampoos, for example, actually it doesn't solve the dandruff problem. It actually removes the dandruff. If it had solved the problem, then the business model would have been a problem, because once you start using, you will not use it. But that happens because of scalp. And that happens because of you're having a damaged scalp, or that only a hair nourishment leave-in product can deliver. No? So there are enough opportunities. The problem that had happened in the past in our industry was people were very seed forward. Consumers unfortunately don't look at a seed or ingredient. That they don't categorize a category as amla, almond. People look at either is it solving a problem for me, delivering healthy hair, or giving me beautiful hair. And there is no reason why all the benefits which shampoo delivers today or claims to deliver can be done through this category. So I think that is the shift which we are trying to drive, which is a broader consumer need backward strategy, as opposed to trying to participate that if somebody else has almond, I will have almond. If somebody has amla, I have to have amla. Consumers don't look at it seed forward.
That is more of a me too and not the right to win approach. And secondly, sir, is convenience foods going to be, the next big driver for us, given that, we've done very well in Saffola oats? Is that going to be the next big growth opportunity for us?
See, I think we want to focus, there's enough opportunity to grow the masala oats itself. Because at the end of the day, I think what has happened when we are very happy is that it started off as a breakfast, and now today significant portion of our consumption is happening is in between meals as a healthy snack. And therefore, and it can replace anything. It can replace any healthy snack, any other snack, unhealthy snack or a healthy snack, okay? So I think it's very nice to jump from A to B to C. The first point is I think we should be doing, as I said, anything between 120, 130 crores this year. The next stop is getting into 200 crores where we start making money. And yes, we have an aspiration to develop a food business into a 500 crore business, but I would like to have focus. It's very easy to lose focus and try doing lots of things rather than growing one or two segments. And we will focus on these one or two segments which are in the area of what I call healthy in between meals, which is a snack or anything like that. And there are enough opportunities for doing that. So we don't get ourselves into cookies or anything else, if that's the...
Thanks.
Gives me a chance to ask another one. Sir, about 3 years back, almost 2.5 years back, we forayed into skincare, as being an adjacency. The first 12, 18 months, we saw immediate success. And since then, it's been steady, lotions business. Obviously, the category itself has slowed down a bit, for sure. I just wanted to understand, how you look at a larger skincare play, if possible, over a period of time. I understand, and why I ask is because within personal care in India, still hair and skincare are the two large pieces, and within hair, shampoos is already cluttered, or you can say the top two players are very, very aggressive. So, within personal products, how do you see the rest of the genre with a specific thought on skin?
See, I think you're absolutely right. When we entered the category was growing in 15-20%, and after that, any of the so-called discretionary personal care categories, when the urban consumption slowed down between 2013 and now, actually have not shown that growth. And the same the case with some of the other portfolios which we have. I think we started off well. We have a good product. I think it was differentiated. I think we are now stuck at a certain market share of 7, which we have not grown in the last 2 years. We haven't done a good job on that. I think what we have to do is to do the next level of disruption and the next get our act right to get it into 10% plus. And I think, are we happy about what we have done in the last 18 months? while you can blame the category has not grown, we are also not happy. We have also not grown shares significantly. So you have a job to be done. We have skincare expertise within the group per se. And therefore, yes, I think it's an opportunity. And someday we believe that this is a sector, and I think we understand Indian skin, through Kaya or anything else. And therefore, there is strong insights, there is technology capability and other things. And therefore, I'm sure that there would be a route out, and we are interested in this segment.
And just one more thing was, it was very interesting over the last few interactions that you have possibly once again started talking about inorganic opportunities. I think possibly that's now I won't say resurfaced, but slightly more given more importance in your overall strategy now. Indian opportunities for inorganic growth are not acquiring companies nowadays, but more distribution penetration led. How do you see acquisition as a growth strategy, not only for India, which is a very hard market to acquire companies, but other emerging markets?
So I will break it up into two. As far as India is concerned, I think we have to still digest the last one, and we have to make it a success. Okay, so I still believe we did the right thing. It's just that there were certain factors and certain choice making which we did post the acquisition where it didn't go right, and we are now sorting it out. Okay, I think as far as international markets is concerned, there was a hiatus as far as inorganic is concerned, is because we wanted to get the backbone right. If you knew that slide about that playbook, I think a lot of areas in that foundation was not right. We were growing fast, we were growing entrepreneurially, but we wanted to get it right. So what we want, and hopefully by in the next 6 months, I think we have solved the Egypt problem, we are solving the Bangladesh problem, we have solved the Middle East problem, we are mostly solved the Southeast Asia, wherever the transition is there. So most of the international business solutions are in place. I see the visibility. And you would see perhaps decent growth as we move in the next couple of quarters. I think we need to have the confidence to do first organic growth. Only then you can chase inorganic. And also I believe now, given that some of the countries with depreciation, the currency, the lower it could become attractive. Say a market like Indonesia and something like East Africa could be attractive. There could be even some scale buys in that. As far as the other thing shift in our M&A is concerned is, we are also now open to make strategic investment in adjacencies, something which we can't do ourselves well. Also, some things which, if it comes within a large setup, although we are more entrepreneurial than others, but still professional managers are risk averse, let's be honest. So we don't want to, we would happy to do some stakes in some startups. So I think one of the companies I said I admire a lot is Hector, but similarly we have done some small investment in this company called Bellazimo, which actually invests in, which has created products for the salon channel. So therefore we are happy to look at more these kind of investments where we invest in adjacencies where Marico can gain, but we let people who are entrepreneurs run the show rather than getting us to run it. Because I believe, in hindsight, if we had done similar thing with maybe in a DO category, we might have done better.
Hi. So if you go to the tier 3 cities or even in the rural India, there would be a lot of people who would not be using shampoos, but they would be using Parachute. So when you go to these places, there are still a lot of people who use soaps and they don't use shampoo, but they still use Parachute. Parachute is a big brand name in tier 3 cities and rural India especially. So don't you think when you say that this shampoo market is totally cluttered, you are losing this opportunity to use the brand name of Parachute for coming into shampoos? Because these people would slowly move out of using oil and they will move on to shampoos. And that is the point where you can use the brand name of Parachute for, because for them hair care is one thing. It can either come from a shampoo or from an oil. For them till now it is coming from Parachute. So
I think the shampoo category is extremely cluttered. A significant portion of the business, 70% is in sachets, where unless you have scale, you will not perhaps get profitability or break even. The share of voice, per share of voice, the dollar is significantly high in a shampoo category. And I think empirically, I think it's not about brands. Empirically, you will know that any category with shampoo penetration continues to be high. Any category with high penetration, with consolidation of market share amongst three leaders, and in this case, between P&G, L'Oreal, and Unilever, it's around 80%. I think it doesn't make sense when you have headroom for growth. And see, ultimately, resources are scarce. So the question is, where would you put your resources to maximize your growth? I think that is how we do it. I think when a lot of things on Excel looks nice, but actually, when you actually implement it, it's different.
Thank you, sir, for a very engaging presentation. I wanted to ask you that since you addressed rural markets and distribution to be one of the key factors and the competitive advantage for the FMCG players, when you address in rural markets, a lot of your competitors, for example, Unilever, have come up with attractive strategies such as Project Shakti, where they empower women in villages to distribute their products. Is Marico looking at certain strategies which will actually help increase the penetration in rural markets?
Yeah, so if we look at, compared to, say, some of the other players, I think we were a little under-penetrated in rural markets. Our direct sales contribution 3-4 years ago was 25, we have pushed it to 32. As we move to around 35, I think we'll have a level playing field. Yes, we are doing a lot of things. I must say, however, as an organization, we are not good in branding projects. So therefore, we might be doing a lot of initiatives which we don't brand them and actually do it. But yes, we are doing some kind of initiatives in that. So having said that, I think the question is, how do you get direct distribution? I think one of the things which our Shanti Amla foray has done in the last 4-5 years, you need always a leader brand for other brands to ride piggyback on the distribution, because you need a critical mass, because otherwise the chicken and egg, whether you have costs or you have incremental returns. So we now have in each of the parts of the country, so in the north and some part of the Hindi speaking market it's Shanti, and in east it's Nihar, rest of the places Parachute, where you have a carrier brand to drive it. And therefore, I think in the next 2-3 years, we will get a level playing field as far as catching up with the other players are concerned.